So for years, the public markets were really the ultimate outcome for startups. It's how they gained credibility, scale, and liquidity, but that has been changing lately. So while, yes, the IPO activity is picking up, you've got Circle and Chime, for example, it is well below the highs, well below the long-term averages, and more companies are just opting to stay private or avoiding Wall Street altogether. So as valuations hit new records in private markets, how does this all end? What's going to happen to what some are calling the forever private companies out there? Here to talk about the exit playbook changing and what it's going to mean for Silicon Valley is Dharmesh Thakker. He's partner at Battery Ventures. Great to see you.
Thank you, Kate. Thanks for having me here.
Of course. So does that resonate, these forever private companies? And how is the landscape changing right now? Do you expect some of your portfolio companies to just eschew an IPO and say, you know what, we're going to stay a private company, maybe for the rest of our lives?
Yeah.
Are people saying IPOs aren't necessary?
I disagree, unfortunately for some. I think IPOs are healthy, but it's not for every company. If you look at the rough numbers, there's about 15 or 20,000 venture-backed startups, but only about 105 to 110 public software companies, and only about 30 of them that are more than 10 billion in market cap, which is kind of what big venture funds like us count on. So I think they're generally healthy, but it's not for everyone. The reason I think companies have been largely staying private the last few years is, number one, I think it's become much easier post-ZIRP era to raise money in private markets on very generous terms and less scrutiny, which allows for quality companies to raise things much easier. As you can see from OpenAI raising 40 billion, I think that was the largest private round ever. That's probably larger than the market cap of most companies just in that raise. But I think the more important part is companies that go public, the worst thing that could happen to them is missing a quarter, 1 or 2 quarters after they go public. And with the market environment being so volatile, it was really hard for companies the last 3 years to predict if the demand environment is going to stay strong or not. I think a lot of that is changing. The demand for AI companies is now as robust as ever. I expect most companies in the AI or software space to see good visibility in the next 6 to 8 quarters. So the demand environment is strong. Secondly, I think for employees, it's a good thing for them to have liquid public stock. It's great to get secondaries and some private tender events, but generally it's healthier to have liquid public stock. And I think third, in general, for investors, they're so indexed to the Magnificent Seven. Those trades have gotten very crowded, as you can see. The top 7 companies, I think, make up 55% of the market cap of the entire tech landscape. So investors would like to diversify beyond that, as you can see from the performance of Palantir and CoreWeave. So between investors demanding more IPOs, founders seeing a stable demand environment, and employees generally benefiting from liquid public stock, I think there's need for more public companies, and you should see that change in the next few quarters.
What does that mean in the next few quarters? Do you think this is near term, within the next year, we're going to start to see AI companies? Because we've seen a couple I mentioned, Chime and Circle, which are more fintech and crypto. When will the AI companies start to try to list?
You saw CoreWeave go out a few quarters ago, or a few months ago, I should say, and they're trading, last I checked, at 72 billion, which is close to 30 times revenue. I'm not sure that's warranted, but certainly it's a healthy environment for AI companies. And so I think the next couple of quarters, assuming the inflation or the macro environment doesn't go through the same volatility we saw the last few months, should generally be a good place for companies to go public.
Are you hearing that from founders? Any fear around the volatility we're seeing in public markets and saying, okay, that would actually delay a decision to go public?
It depends what day of the week you ask them. I mean, the markets have been so volatile that if you asked them a month ago, they would have told you, even bankers I talked to, lead bankers I talked to at Goldman, Morgan Stanley, and others, would tell you, hey, the market's shut down for the rest of the year. And then 2 or 3 weeks later, it's like, oh no, second half of the year looks really good. So there's so much volatility with the macro, the tax bill that's ahead of us, and what that means for inflation in the next 3 to 5 years, that if we were to ask founders today, they would probably want to see a stable environment for 2 to 3 months in a row. And if everything stays the way it has, the second half of the year and the first half of next year looks quite conducive.
So you mentioned these tens of thousands of companies that are out there. What happens to the rest that maybe are not IPO ready? Does that mean there's an acquisition on the horizon? What is the outcome for some of these companies that are not the top tier, the Databricks of the world, and are sort of in this middle ground?
Yeah, that makes up most of them. So Just by way of background, Battery Ventures has been around for 40 years. We manage roughly 20 billion. Focus exclusively on B2B software companies, plus some life sciences as well. And we've seen, early stage venture exits to strategic acquirers. We've seen a number of companies go public, but we also have a thriving private equity business for the last 2 decades. I know a lot of people have been talking about private equity as like this new hot thing. We've been doing it for 2 decades, right? But it's all software focused. And so the way we see early stage companies playing out, most of them fail to break out and get strong product market fit, but they're strong technical teams. And it's much easier to sell a company to a strategic after a Series A or Series B. It gets worse if you defer the pain and you raise a lot of money and then try to sell it to a strategic. So a company that has raised 30 to 50 million but has been unable to break out, there's a lot of strategic activity for those companies. On the other end, there's companies that get to 300-400 million, still growing 30-40%, and they have a very nice path to go public. But the remaining 90% of companies, which are in the middle, right? They fall in 2 buckets. The ones that see that there's no strong product market fit and they're efficient, they don't burn too much money, and they're profitable, they could be taken out by private equity buyers. There's a lot of dry powder in private equity, roughly 4 to 4.5 trillion. They've been acquiring a lot of companies. And then there's the other companies that raised too much money in 2021-22 timeframe, and they were unable to distinguish between the ability to raise money and the desire to spend it. And so if you raise too much money and spend too much money, it's very hard to change those habits. And unfortunately, a lot of those companies will die.
The latter seems like it kind of rhymes with what's happening potentially in AI right now. I think of the large language model companies, it's probably too soon to say, but they're raising so much money. How do you think about the return on that investment?
Yeah, we've looked at most foundation model companies, and as a firm, we've decided to stay away from most of them for exactly that reason. The venture business relies on putting a small amount of money in companies to see if there's product market fit, and then as things work, you put more fuel in the fire, and then you go along for the ride. Foundation model companies seem to be the exact opposite. You could put $300 to $500 million and find out you have a model that is not that distinguishable from what Facebook open source Llama model has done or what DeepSeek has done out of China. So we've largely stayed away from them. And you're right, there's a couple of them, seems like OpenAI, perhaps Anthropic are breaking out, but there's hundreds of millions that has gone in a dozen other foundation model companies that probably won't yield positive returns for the investors. There may be good acquisition outcomes for an Amazon or a Google or Microsoft, but it's unlikely to generate venture-like returns, just given the capital intensity of those companies.
Is it too late for one of these big strategics, big tech companies to come in and buy a company at this point? I think of OpenAI at $300 billion. Can anybody afford to swoop in at this point?
I mean, look, I don't have a magic ball here, but I don't think Sam Altman wants to sell OpenAI, just given how easily he can raise money. And it seems like his aspirations are to go beyond foundation models and get into enterprise. You covered that this morning, or potentially get into chips or get into small nuclear reactors. I mean, the aspirations are far and wide. So it doesn't sound like he probably wants to sell the company. And at $300 billion, he's larger than 99% of most software companies.
He's kind of a hyperscaler, I guess.
He's pretty much a hyperscaler, right? If you were to take Google's cloud business out, it would be comparable to where OpenAI's total revenue would be in the next year or 2. So, so companies like that, I doubt, are up for sale. But others, there's a dozen other foundation models that are raised, 100 to 500 to $1 billion, and the distribution benefit they get from an Amazon or Google buying them might make it worth the while.
It's interesting, coming into this year, I think there was a lot of talk about antitrust and sort of this changing landscape, a lot of excitement around M&A. Flash forward to where we are almost halfway through the year. It doesn't seem like the big tech companies have been off the hook, at least yet. Are they able to do strategic acquisitions, and is that lane really open in a way that we might have expected in the new administration?
Yeah, I mean, look at Google and Wiz, $32 billion for a $1 billion business. I mean, I think Google paid a high multiple for a highly strategic company.
Is that going to go through, though? Like, with everything going on with Google and the DOJ?
I mean, I've talked to some of the bankers who are very creative in terms of working around any antitrust issues, and there seems to be a meaningful breakup fee that Google got comfortable paying or willing to pay. So my impression is that they feel very confident that's going to go through. Then you see ServiceNow and MoveWork acquisition for $2.85 billion. And so it seems like the market certainly has opened up for strategic acquisitions, which also indicates that these large companies are seeing a robust environment for AI and security companies, and a stable demand environment.
And what was Salesforce and Informatica, I guess, was last week.
Yeah.
As we talk, you mentioned the Mag 7 and how much attention it's gotten. In the beginning of the year, too, it seemed like there was sort of this software recession, at least. I mean, though they were not valued anywhere near some of the hype around AI with Mag 7. What was that like to witness as a software investor? And what did you make of sort of the underperformance of maybe the mid-cap software names out there?
Look, we don't do public market investing, so these are not my firm's views. These are my personal views, if you will. I try to separate out the fundamentals of businesses from sentiment-induced ups and downs, if you will. So post-Liberation Day, I think it was a great buying opportunity for a lot of companies. And so, my focus is much more on infrastructure, middleware, some applications. And so I saw that as a great buying opportunity for companies like MongoDB or Datadog or others that were being hammered due to a lot of the tariff movement and what that implied for interest rates and the demand environment. Even the hyperscalers. I mean, there's a meaningful drawdown from the NVIDIAs of the world to the Amazons of the world, which are now up 30, 40, 50%. And if you looked at it, it was mostly driven by macro and interest rate concerns and anticipation of tariffs. But the last few weeks, it seems like President Trump's posture is much more negotiations, using tariff as the lever, as opposed to truly inducing tariffs. And so they've seen a big bounce back. But all along, the fundamentals of those businesses and the growth numbers that they've posted haven't really suffered that much. And so there's a good buying opportunity earlier in the year.
What has the macro environment and some of the fears around recession meant for enterprise spending? Have you seen any sort of slowdown yet? Or are you anticipating a slowdown?
I've seen a slowdown in most things that are not AI related. Most companies are looking at AI as a key to survival. If you don't have an AI strategy in the boardroom, as a founder, CTO, VP of engineering, you're kind of host. And so companies are freeing up dollars from compliance software or risk management software or accounting software to make room for their AI initiatives. And so there has been a slowdown in some of those categories. I mean, if you look at Salesforce numbers, the reason they potentially bought Informatica and own Backup and MuleSoft and many of the data integration companies is in their own go-to-market software stack, there has been consolidation and slowdown as companies need less and less salespeople. A lot of the risk management software has seen a slowdown. On the other hand, anything to do with code automation using AI, using companies like Cursor or Codium, or you look at sales management using AI. I'm on the board of Gong, which is an AI company targeting sales guys. Demand environment has been very strong. So it's a haves and have-nots, and so it's a mixed picture out there.
What does it mean for your portfolio, the companies that are not AI related? Is that affecting valuations yet?
Is that such a thing? Every company seems to be AI related. Even if you're not, you just make it, .ai, and then you're an AI company.
Are people AI washing at this point and just slapping the AI name on the
there's
end?
like 600, 700 unicorns from 2021 that look like they won't go public anytime soon. And so the first thing they do is they call themselves an AI company. The second thing they do is they cut down their expenses using AI for code automation and sales automation, and then hope for the best.
Can you see through that as an investor? Do you say, oh, this is actually fintech masquerading as an AI company?
Yeah, the beauty of being in this business for 10, 15 years is you see the same companies make the round trips, Companies that started as a SaaS company, then became a cloud company, and is now an AI company, but the underlying product and the customers are the same. So we do see that brainwashing. Any company that is kind of like 50 million plus, and in the pre-chat GPT era, it's not truly a Gen AI company. But many of them have transitioned well. Most of them have just, kind of washed their pitch with some AI talk.
What has that meant? I'm just thinking of crypto actually for a second too. Yeah. Did you guys get into the blockchain bubble at all? Did you do any blockchain?
We were investors in Coinbase. We kind of believed in being the, funding the arms merchant behind the scenes as opposed to taking sides on specific crypto. Sure. And I'm not a crypto expert by any means. I generally invest in things I understand, I can feel and touch and talk to customers. Yeah. By virtue of that, crypto is something that I don't really spend that much time on.
And clearly a category winner for Coinbase, so that's a good outcome, I think, at this point.
Yeah.
As we talk about the AI, what it means for private companies, have you seen margins improving with vibe coding and just being able to use it for efficiency? What has it meant for portfolio companies?
Not yet, but it seems imminent. What I've seen, ChatGPT, kind of late 22, call it 23, was mostly a consumer phenomena. I have 3 or 4 different search boxes on my browser now besides Google Gemini. I have ChatGPT, I tried Perplexity. And then in the last 12 months or so, it feels like enterprises are now starting to build AI applications internally and use AI for internal operations. So the 2 main areas I'm seeing, one by virtue of Gong, where I'm on the board, is companies adopting AI for sales outreach, sales engagement, forecasting, and then secondly for code development and code automation. A lot of that was experimental to kind of A/B test the quality of the results, but it seems like the results have been good enough that they're moving to production. And so at least on the large company side, I expect your operating margins to improve from 30-35% as a mature software company to potentially 40-45%, maybe even 50%, just given all the efficiency that you see from AI, which is incredible. I mean, think about all the value creation you will see if margins improve by 10-15% thanks to AI, at least on the public or large company side. On the startup side of things, it's kind of a weird phenomena where companies are saying that AI is making our operations so efficient, and yet they turn around and go raise a few $100 million at an early stage. I'm like, why do you need to raise so much money when your operations are so efficient?
Why do they?
And I think there's a class of founders. A lot of founders right now are predominantly first-time founders. They grew up in the AI era, the post-ChatGPT era, relatively young founders where they equate fundraising as the proxy for success. Like, well, if I raise 100 million, I can hire great engineers. I can go out. I can beat out my competition. Except everybody in your space is raising hundreds of millions. And so I just hope all these venture dollars that are going into early stage Gen AI companies don't really get washed down doing kind of the inefficient things like hiring people for the sake of it, or hiring a lot of salespeople, or doing a bunch of marketing is only going to benefit NVIDIA and Google as you buy chips and post ads. It's unclear if it's going to go drive efficient return of capital for those companies. So that's the dichotomy of this AI wave where startups that are efficient are raising more money than they need.
That's so ironic because I think the initial reaction when we heard about some of these efficiencies and what it means for coding, even Satya Nadella is saying, it's doing at least 30% of coding at this point. Zuckerberg, I think, said 50% as of this year. That's so fascinating that it's actually not causing founders to say, all right, we need 5 people in a dorm room and that's it.
What's interesting is for the first time, I mean, I operated for 10 years from, call it the internet era, and then I started investing in the cloud era. So for the last 12 to 15 years, I've never seen companies that have 6 to 10 people and can get to 4 to 5 million in revenue. There are companies that have not raised money, they've been bootstrapped, 6 people, and I just saw them, they got to 4 million in revenue, which is unheard of. Because you can get a product out in 2 weeks as opposed to 2 years or 6 months. You can test it out using some product-led growth mechanisms. You can use AI software to engage prospects and sell to customers. And so it has been done and it's been shown. And yet those same founders that have been successful getting to 4 million and 6 people, then turn around and say, now I need to go raise 100 million or 50 million as a Series A. Which usually we recommend them not to do, saying, look, focus is driven by constrained capital. You should have enough to extend your runway by 2 years and achieve your milestones for the next 2 years, and maybe add a 6-month cushion. But anything beyond that, you're diluting yourself more than you need. You're better off raising money down the road, and it's going to keep you focused. And the employees you want to hire purely by virtue of a big round are the ones who will leave the moment you have some slowdown in the business, which is inevitable. So stay focused on quality, results, and the right kind of employees by raising the right amount of money for a 2 to 2.5 year runway, not beyond that.
Is that advice you're able to give founders, while at the same time I would think you probably want to put money into their company? Yeah. How do you balance that?
Look, at the end, our fiduciary duties to our investors, including some endowments who probably will have to pay taxes going forward, to generate returns for them. And the best way to generate returns for them is to not overfund companies at the wrong stages. So we fundamentally take the view that we'll invest at a Series A, Series B, but our reserves for companies are substantially larger. So in several of my companies, including Databricks or Gong or many others, we'll start with a 20, 25 million check, but we'll invest 200, 250 over time as the results start showing, because we're looking at this as a 10-year window. Right. And fortunately, in my career, I've seen 4 companies go from single-digit millions to single-digit billions. And so that's given us enough opportunity to invest money over time. I can systematically tell you if we had given them more money earlier in the cycle, that probably would not have been that great for those companies because they would have been defocused. And by giving them money as the data became evident, that was in the best interest of our LPs. And so I separate out, our large fund size from the timing of when we invest. And so if we stay long-term greedy, both founders and investors can do well.
As we talk about LPs, there's been so much pressure on universities and endowments, especially some of the elite universities out there, whether it's on the political side or the tax bill that's going through. They're going to have to pay a lot more taxes than they were even right now or a year ago. Is that changing the funding landscape and fundraising landscape for you guys, for venture capital in general? And what does that mean as the pie potentially gets smaller for how many dollars can go into venture firms?
Yeah, look, first of all, I'm sympathetic towards, the situation some of these elite institutions are. My son goes to Columbia and all he's seen for the last 2 years is protests as opposed to a good college life. I went to Wharton, I'm on the innovation board at Wharton, and all the discussions that are colored by what the administration means for their long-term prospects. And so I'm sympathetic towards them. But at the same time, as a partner or manager at a venture fund, as long as the returns are good, I think there's enough demand for you, either from endowments or from pension funds. And so there's enough sources of capital that we don't worry about it that much. But my personal opinion is that there has been way too much funding in the venture and private equity asset class since the zero interest rate era. And so some slowdown in terms of LP capital to some of the second and third tier funds would actually be healthy for the ecosystem. Because the last 5 years, the reason why companies are able to raise 100 million at Series A is there's so much capital chasing them. And at the end, even if the number of companies has ballooned by 3-4x, the number of outcomes hasn't really changed. And so the asset class as a whole is getting diluted by an abundance of capital. Now, the flip side is the companies that are winners are substantially larger. We didn't see companies get to 100, 200, 300 billion in private markets or go public at those valuations, right? And so the environment is positive, but there's still a lot of companies. And so some drying up of, LP capital will be healthy for the ecosystem as it reduces the noise from some of the lower quality funds and companies. And it helps higher quality companies get to their end goals faster.
So sort of a healthy reckoning if there's fewer dollars chasing these deals.
Think about it. If there are 5 companies that are going after the same customer base versus 25 companies, you essentially have 20 companies spending a bunch of money in sales and marketing and competing with the 5 best companies that now have to go compete back. And so there's just there's low return on the capital that is being spent on competing thanks to all these companies in the system. If you strip out half of those companies, the outcome might still be the same, but the best companies can get to the growth rates much faster.
It's sort of a full circle conversation too, as we talk about exits and eventual valuations and kind of where we are now. Do you think the current valuation environment is a result of that much capital moving into private equity and VC?
On the private side, certainly. You would think that following what happened in the ZIRP era and the slowdown in IPOs, that there would be a lot more caution on the private investing side. And yet you see AI companies raise money at even higher valuations than they were raising in 2021. That is predominantly due to the excitement around AI, but also because of the abundance of capital. Most of this capital is logged into 8 and 10-year vehicles. So even though there's drying up of new capital, there's still a lot of dry powder in the system that is funding all these companies. So private companies just seem to be in a completely different universe than public companies. Now, when you go public, most of the companies are trading at 5, 6, 7 times revenue, which is a lot healthier than 25 to 50 times revenue. There are a few exceptions like CoreWeave or Palantir that are trading at 30 to maybe 100 times revenue. And that's perhaps based on the excitement around their long-term prospects in the AI space. Again, we haven't really seen that kind of behavior. The last time I saw a company traded 100 times revenue in public markets was Snowflake, and their revenues have since then 3-4x, while the valuation has been relatively flat to down. And so you'll see normalization of those multiples in public markets. But right now, just given there's a handful of names beyond the Magnificent Seven, there seems to be a fair amount of interest in those names, and that's driving up the multiples.
And like you said, interest in sort of the second tier is probably the wrong way of putting it, but just the non-Mag 7 software names. It seems like there's an opportunity for that segment of the market to grow. From
a multiple standpoint or from a revenue standpoint?
For just a total number of companies? It seems like
Yeah.
when there's this flood of IPOs eventually, if that does happen,
Yeah.
do you think there's going to be demand for those software companies?
Yes. So, if you look at if you leave the Mag 7 out, there's still another 20 or 25 companies in enterprise software that are more than 10 billion in market cap. You talk about Datadog, CrowdStrike, Palo Alto Networks, ServiceNow. Most of them are exceptional companies that have got to $3 to $10 billion in revenue across 10 to 20,000 customers. And so those companies, I think, will continue growing just given their their growth rates through the ups and downs.
Right.
If I look at the private universe and I look at the number of companies like Databricks or ClickHouse that we're involved in, or obviously OpenAI and Anthropic, they seem to be even better from a scale and growth perspective than these 30 companies that are more than 10 billion in market cap. And so I expect that when those companies go public, they will see a very strong reception, and the universe of companies that get to 50, 100 billion market cap in software should probably double, is my guess, in the next 5 years. Partly because these companies that have stayed private for so long are essentially operating like public companies. They're just not public yet.
I wonder too about the lines between venture capital and private equity. It seems like they're blurring a little bit as this asset class grows. I know you guys do all of these different stages, but there's a lot of venture roll-ups that seem like it's actually sort of the private equity playbook.
Yeah.
Does that resonate? Do you think the lines are blurring, and are venture firms trying to get it into more of the late stage PE side of things?
Yeah, look, there's been a lot of hype around, venture managers discovering this new playbook of like rolling up venture companies or taking the private equity playbook. It's not rocket science. We've been doing this for 20 years. We have a thriving practice, and we have, 4 or 5 of my general partners who have been doing B2B software, venture roll-ups or private equity execution strategies where you buy a strong platform which is almost cash flow positive, you get them to 10, 20% profitability, you layer on 5, 10 acquisitions that are complementary, and all of a sudden you have this behemoth which is operating much better because you eliminated excessive sales and marketing spend. And so we've been doing this for 20 years. It has worked very well for us. We're surprised that most venture managers were not doing it because growing up in the venture system, I'll say, we only know one playbook, which is, follow great founders, give them capital, let them grow. But that only happens 1% of the time. The remaining 99% of the time, you either have to be realistic and sell the company when things aren't working, or drive them to profitability and grow them efficiently. Now, being part of Battery, where I see half my firm do private equity, that has given me new respect for growing companies efficiently as an alternate way to creating value, right? So there's different ways to create value. When you do both of those in the same firm, you understand and benefit from the knowledge from the other side. And so it's not new news. We've been doing this for 2 decades. What is new is that AI is actually helping you make it possible at a much higher scale.
I was going to say, it's AI. Is this the same as the AI washing we were talking about?
Well, the Gen AI strategies that make this feasible are true in terms of generating code output and not hiring engineers. You could get the same output with half the number of engineers, or make your best engineers twice as productive, or you can increase the release velocity, which grows your revenue more. On the sales and automation side of things, sales and marketing side of things, so there's ways for sales guys to spend 60, 70% of the time talking to customers as opposed to putting notes into Salesforce. And so I think it's real. I think the AI washing is much more companies from 5, 7 years ago pretending to be AI companies. That is the AI washing I'm referring to. But the operational benefits of implementing AI within private equity portfolio companies, I think those benefits are real. We're seeing that firsthand.
How are you thinking about global investing? There is sort of this new geopolitical world order. Are you seeing investments elsewhere? I know you've done a bit of investing in India. How is the political landscape and everything going on with the trade war impacting that or informing that?
Well, first, if you keep the trade war aside, Battery has been investing in software companies globally from our founding days. So we were one of the earliest investors in Israel to identify that a lot of the 8200, their NSA equivalent, students came out and were amazing cybersecurity founders. And so we planted a flag in Israel about 15, 20 years ago. My partner, Scott Tobin, he set up shop over there as one of the earliest VCs. And we've had an active practice in Israel looking for cyber companies. We've looked at a number of software companies out of Western Europe that have also been high quality. And we're starting to look at India, which has been predominantly a services economy, but now going to a software economy. The thing that is common across all those companies is if you're focused on software, the largest end market is the US. So whether you start in Tel Aviv or Mumbai or Bangalore or Brussels, your revenue is predominantly coming from the big banks on Wall Street or from the big healthcare companies in Middle America. And so that playbook has worked for us because we can take these companies wherever they are, keep the R&D shops where they started, but build out the go-to-market machine in the US and help them with that. And that has worked out very well for us, including companies like Gong that start out of Israel, or Colibra, or Mendix, and many others. The political environment is all relatively new. And as much as I hear about the tariff talk, it seems like it's a negotiating lever, rather than truly implementing these tariffs, except for maybe China. Yeah. And we don't invest in China. So I think for the most part, we generally keep the tariff noise out and look for the best companies. And we are seeing more and more quality companies,
Would a more protectionist stance overall change the maybe appetite to come into the US? I know there's been this sort of the sell America phenomenon. You're not seeing that yet.
Not in software.
Not in software.
Not in software.
Fair enough.
I mean, most of the software that sells in America is built in America. So it's not like you have to bring those jobs back, right? A lot of companies that start in India or Israel or Europe have been selling to the US customer base already. The only thing that might perhaps be impacted is companies from the US that are selling overseas to China, maybe to Europe, may see more headwinds. But there's enough demand, especially in the AI side in the US, to make up for that. So I'm not really seeing an impact either on company formation or the growth rates in the AI space based on tariffs.
Fascinating stuff, Dharmesh. We'll wrap it up. This is fascinating, and it's great to get your take on all this. We'll revisit this maybe in a year when we see what happened with the IPO window. And
yeah, let's see how it goes.
Exactly, Dharmesh. Thank you again. It's great to see you in person.
Thank you for having me.